Hello and welcome back to the channel Implied Investing. Today we will be covering WEPN, the Nicholas Defense and Rare Earths Income ETF. But before we hop into that, let me go ahead and give the legal disclaimers. This is not financial advice. I'm not a financial advisor. Before you make any financial uh, decision, please go ahead and check with a qualified financial advisor. This is for entertainment and educational purposes only. With that, let's just jump in it. I really wanted to review this ETF because it is timely. As you know, the U.S. and Israel are conducting airstrikes against Iran, and that is weapons. That is us at war, at an air war, spending money, spending time, spending weapons, and there are lots of companies who stand to benefit from this. Now, looking at the economics of defense, it's important to see, and it's also important to position yourself in such a way, if you so choose, to potentially support those defense industries. Now, this is a I'm sorry, a X funds fund, just like all the rest of them. They have a kind of split personality. They typically will do the equities of the companies who actually make stuff, and then they'll do the uh, commodity of the stuff that's actually being made. So, for example, in blocks, you have the companies that empower crypto, and then they actually hold a little bit of crypto. Actually, not a little bit, they hold a lot of crypto. So this fund is split up very similar to that, or their silver fund or their gold fund, where they'll hold gold and then they'll also have the miners. So it gives you very complete exposure to the industry. Now, if you're interested in defense and rare earths, this fund will give you that exposure. So if that's what you're looking for, let's stick around and we'll dive in. So the ticker name is WEPN. It has a market price at the time where when I got this of about $48.52, which was about a week ago. But it's only increased in value, as you can see down here at the uh, screenshot that I pulled from Tapping Alpha. Love those guys. I'm not sponsored by them, but it is a heck of a research tool. This is probably the only X funds ETF that is in the positive on price return. It is probably the only ETF that's in the positive on price return. So the fund is a little over 2 weeks old, almost 10, a little under 2 weeks old. So this is not a whole lot of track record, but as you can see, it is positive. They picked a heck of a time to launch it. It has a pretty high expense ratio. Assets under management are tiny. I do expect that to grow 6.17 million. It's targeting weekly distributions. Now, there haven't been any official declared yield that they're searching for, but from interviews that he's done, he said anywhere between 14 and 22%. And I did my own math, and we'll get to it a little bit later. And that's about what his options that he pulled, the options that the fund holds, that's about what they can sustain. So, um, word to the wise, for my fire investors, this may not be for you. That expense ratio is pretty high, but you are getting active management. You are getting exposure to a asset class that not a lot of people are into yet. That not a lot of fire investors are into. So with that being said, let's move on. Just talking about the three-part strategy, this is kind of how X Funds does their funds. I think it is probably the future of funds because it does give you that complete exposure. So you have the defense and rare earth equities, which are 25 to 75% of the fund. You have the strategic commodities that make up about 25%, and then you have the options overlay. So it's handpicked defense contractors, cybersecurity firms, and rare earth miners, right? Selected for intrinsic value and implied volatility. Got to have that volatility in there to get the call options and the put credit spreads. Then you have the strategic commodities, which are direct commodity ETF exposure based on metals, steel, platinum, copper, lithium, and uranium. That is achieved by using synthetic longs and your options overlay. And just like the rest of X funds ETFs, They not only play the call side, but they play the put side. So it does put credit spreads on the equities and call credit spreads on the commodities with weekly expiration dates. This defines their risk via the spread. But with the put credit spread thing, once they break your strikes, there is no consolation prize the way it is on a covered call. They break your strikes, well, at least you kept the premium. I guess technically there's a small premium that you receive when you open the put credit spread, but it's never as much as you paid to open it. So just keep that in mind. Now here are their holdings. This one is it's a very well balanced. So you have defense primes, you have commodities, the commodity ETFs, you have defense and tech cyber, you have critical minerals, you have emerging defense, and then the rest is held in cash so that they can run their option strategy. But you're getting some very cutting edge names in this, and you're also getting some legacy defense names in here, like Northrop Grumman, General Dynamics. But you're also getting that cutting edge names like Palantir, CrowdStrike, Arrow, they're making drones. Lockheed Martin, one of the more legacy companies. RTX Corp. You are getting a very well-rounded access to the U.S. defense markets. Now, looking at the commodities, which represent about 26%, and the critical minerals at a 14%. As you can see, I already read it, but you have base metals, you have steel, you have platinum, you have copper, you have lithium, you have uranium. These are very, very in demand. And as the AI trade increases, you're going to see more copper. Lithium is for batteries, and as cars become more electrified, you're going to need more lithium. Uranium and plutonium. I'm sorry, uranium, not plutonium. Uranium is used for the nuclear reactors, which are critical for the future of AI because it puts these things. AI compute is very energy intensive and needs a lot of energy, and the best way to do that on Earth is to run it through a nuclear reactor. Platinum can also be used as an industrial metal. A lot of satellites have it. Copper, self-explanatory. Steel. Uh, the U.S. is used to buy a lot of steel from China, but because of the tariffs, the U.S. steel industry is making a small comeback. So that's just the equity exposure. That's the commodity exposure that you're getting with this fund. Now into what everybody's here for, the options overlay. So as you can see, out of the 22 puts, 20 of them are already in the money. And out of the uh commodity call, I'm sorry, out of four of the six calls are out of the money. That's fine with the call side, but on the put side, this is dangerous. He did launch at a very good time for defense stocks, but these put credit spreads and the oil market right now are causing the market to do crazy swings. So from what I saw in the fund's holdings, they're typically 7 days out, so they may have recovered. I pulled this on the second day that the fund was out, so a lot of these things have recovered. There was a huge drop. They may have recovered, and hopefully they did, and that he didn't end up in the red. The fund didn't end up in the red and losing all of this put credit spread money. But the rare earths and critical minerals names sold off very sharply. The fund wrote near or at the money puts to maximize the premium, but the underlines moved against them within 48 hours of the launch. The max losses are capped, but that doesn't mean that the NAV isn't going to take a hit. So one of my big rules is that I do not invest in funds that have terrible NAV decay. It's one thing if the net asset value is dropping because the fund's underlyings are dropping, that's perfectly fine. That's expected. You're in the market, that's what you're going to get. But if you are over distributing, that's a fund that I cannot invest in. Just cannot invest in. If your option strategy has no hope of meeting the distribution rate, that's a fund that I don't think anybody should be invested in. So let's analyze that right quick. The options that are over the notional are about $5 million. Monthly premium, so they would need to make about 100K. That's 2% a month. Monthly premium net is 60 to 80K. The price I'm sorry, the amount that they would need to pay out is 0.56 cent per month, and per week that's 14 cent. That's an annualized rate between 14 and 22%, which I think is very doable for these names and for these commodities. I'm very happy with X funds, Mr. Nicholas, for not going for 35 and 45% the way he did with blocks, which can sustain that type of volatility, but GIAX has no hope of doing 24% for the names. He needs to lower that to about 17%. And with that, thank you for coming to my TED Talk. I will get off my soapbox about GIAX because I love that fund's underlyings, but it distributes too much, and you're seeing potentially NAV erosion. Like everything has to go just right for them not to have NAV erosion. Anyway, back to weapons. Not We're not talking about GIX. The annual distribution rate is between 14 and 22%. The annual premium income that they need to make is about 720K to $1.2 million a year. Um, Annual distribution rate at 20% would be 1.22 million. So the question is, can they cover their distributions? And based on their options and the options that they took out, they can, but just barely. It's one of those funds very similar to GIAX where everything almost everything has to go right in order for them not to experience NAV erosion. And here's an important point that you may not know about ETFs, especially actively managed ETFs. They get better with time. They get better with time because the fund managers understand better what they're doing, understand the markets that they're in a tad bit better, understand how to write their options a tad bit better, how to avoid NAV erosion a tad bit better. But is that enough to uh, give you comfort that they're going to execute this strategy correctly? It gives me a little bit of comfort, but I don't know. I do not know. I truly don't know. He could mess it up, and this fund is just another, NAV decaying high yielder. That is 100% possible. Okay. So the fund doesn't really have any peer comparisons in the income space. Most of these funds are the best I could find that they don't really have an options overlay, right? These are just straight up defense ETFs. So just straight up defense ETFs. You have ITA, you have Shield. I used to own Shield. You have REMX, and you have blocks. The benefit with this fund, just like with all of income funds, is that you can make money while these commodities and these equities go through hard times. So that's one part of the reason I hold blocks, is because crypto can go through crypto winter, and instead of me selling because it's paying me every month, this is a way for me to help me hold. It's a psychological hedge, and weapons would be my psychological hedge for holding hard metals, not silver or gold, but holding copper, which is expected to do extremely well. Okay. Moving on to our next slide. Reasons to buy. Macro timing. And when I tell you he couldn't have launched this fund at a better time, it has all the conditions necessary to continue to succeed. The rare earth thesis, as you guys know or may not know, China does about, I want to say, 80 to 90% of the rare earths. And rare earths aren't necessarily rare, it's just that they're very, very difficult to refine, and they have most of the refining capacity. These high IV premiums, so there's quite a bit of volatility in these names, especially during times of conflict. And there's we are not lacking any conflict out there. So these names will continue to have a lot of implied volatility. It's truly novel, which means that nobody else is doing this. The way he structures his funds Literally nobody else is doing this. Defined risk, I guess that's a reason to buy. But that's more of a reason that for the fund not to not to lose all of its NAV because they can only lose so much at any given time. Reasons not to buy. On day two, it was underwater. Zero track record. This fund literally came out less than 14 days ago. Tiny assets under management, which means that there is a real possibility for the fund to close up and call it a day. It has a high expense ratio and it's not diversified. It is all about defense and rare earths, and the two work hand in hand. Military equipment uses rare earths. These two walk hand in hand. So if there's a downturn, then you're going to get hit twice. But it is a bold thesis. It's brand new and unproven. For most people, I would say wait 2 to 3 months of distributions before committing capital. Now, I want to talk a little bit about how I plan to use this in my portfolio. And here's my thesis. My thesis is that I have a lot of exposure to the S&P 500 and to the Nasdaq. I don't really have any real exposure to commodities. And that's just the truth. I have KYLD holds gold and silver, okay? So I have that exposure, but that's less than 15% of my portfolio. I would like to keep equities, S&P 500, Nasdaq. I would like to get that to somewhere around 50 to maybe 60% of the portfolio. And then the rest kind of have in REITs, um, BDCs, have in commodities, and just make my portfolio a little bit more well-rounded. Actually, that's pretty good. So 70% can be exposure to equity, like core equities, and then 10% goes to REITs, 10% to BDCs, and 10% to commodities, and that'll give me 100%. So that's if I do buy this fund, that's how I plan to use it. Um, yeah, that's how I would plan to use it. So I hope you guys enjoyed this quick review. I think this is the only review of WEPN that's out right now. So make sure that you like it, leave a comment, leave your questions in the comments, and don't forget to subscribe. With that, I'm gonna go ahead and call it a day, and God bless, and you guys enjoy the rest of your day. Have a good one.